A bailout refers to a financial intervention or rescue package provided by a government, central bank, or other entities to support and stabilize a struggling company, industry, or financial system. It involves providing financial assistance, often in the form of loans, guarantees, or capital injections, to prevent the collapse or insolvency of the recipient. Bailouts typically occur during times of economic crisis, financial instability, or systemic risk, where the failure of a company or sector could have severe consequences for the broader economy. The primary objective of a bailout is to prevent the negative spillover effects, such as job losses, market disruptions, or a contagion of financial distress, that could result from the failure of a key player in the economy. Bailouts can take various forms depending on the specific circumstances and the nature of the industry or sector in need of assistance. In some cases, a government may provide direct financial support to a struggling company, such as through loans or grants, to help it meet its immediate obligations and continue its operations. Bailouts can also involve the purchase of distressed assets from troubled financial institutions to stabilize their balance sheets and restore confidence in the financial system. One notable example of a large-scale bailout occurred during the 2008 global financial crisis. Governments and central banks around the world intervened to stabilize the financial system, injecting capital into troubled banks, guaranteeing deposits, and implementing measures to restore confidence in the banking sector. These bailouts aim to prevent a collapse of the financial system, restore liquidity, and mitigate the potential economic downturn. Bailouts are often subject to debate and criticism. Critics argue that bailouts can create moral hazard, where companies or financial institutions take excessive risks, knowing that they will be bailed out in times of trouble. They argue that bailouts can reward failure and undermine market discipline, as poorly managed companies are shielded from the consequences of their actions. On the other hand, proponents of bailouts argue that they are necessary to prevent wider economic damage and maintain financial stability. They contend that the failure of large companies or institutions can have systemic consequences, leading to a domino effect of bankruptcies, job losses, and market disruptions. Bailouts are seen as a way to safeguard the broader economy and protect the interests of employees, shareholders, and the public. In recent years, discussions around bailouts have also extended to issues such as environmental sustainability. Some argue that companies or industries heavily reliant on fossil fuels should not be bailed out, as it could perpetuate unsustainable practices and hinder the transition to a greener economy. Others advocate for targeted assistance to facilitate the transition and support workers in affected industries. In conclusion, a bailout is a financial intervention provided to struggling companies, industries, or financial systems to prevent their collapse and mitigate wider economic damage. Bailouts aim to stabilize operations, restore confidence, and prevent the negative spillover effects that could result from a failure. While bailouts have faced criticism for moral hazard, they are viewed by others as necessary to maintain financial stability and protect the broader economy. The design and implementation of bailouts require careful consideration of the specific circumstances and potential long-term implications.